Okay, next question is from Steven. It says, Is that with
a PH or a V?
This is with a V.
Oh,
Steven
wow.
with a V.
I misspelled it. I wouldn't have known I misspelled it.
How could you? Good thing we clarified. Steven asks, I have been working while my wife finishes her doctorate in fine arts, so not high paying. Now that she's done, should we stop saving to help pay off all of the new debt, which is about $70K?
Well, Stephen, I'm going to use you as a cautionary tale. I apologize, but this is an educational program. We want to educate others, and I'm assuming that you'll be okay with this. If not, I apologize if not. But you just said something. You're kind of recognizing this, man. My wife is going to graduate with this degree, and it's a low paying. It sounds like it's going to be a low paying career. And yet we have a lot of student loan debt that is going to have accumulated to acquire this degree that's going to be low paying. Well, that's what we would call a negative arbitrage, right? I bought this thing, this education that cost this much, but the payoff I'm going to get from it is lower than that. What we would like to see in an ideal situation is, can you balance those? Our rule of thumb is that you never really want to have student loan debt that exceeds more than what you expect the first year salary in your vocation to be. And if you can do that, you're likely going to set yourself up on solid foundational footing. However, we know, because the studies let us know, tons of Americans don't find themselves in that situation. They find themselves in a situation just like yours. Hey, we're about to have a lot of debt. How do we approach this? How do we tackle this? How do we think about getting out of the student loan debt?
Well, so go to moneyguy.com/resources or go to moneyguy.com/millionaire mission. I've got a book that details all the steps of the financial order of operations and the mindset and the origin story. And you need to quickly figure out the student loan rate that's your wife's subject to. Is that going to be high interest debt? Is that going to be low interest debt? And if it's high interest debt, let me give you some perspectives. If you're in your 20s, it's 6 and over is what I consider higher interest. If you're in your 30s, it's 5%. If you're in your 40s, it's 4%. Because we want you to be out of student loan debt at some point in your life. But that's going to kind of prioritize where you are in the financial order of operations on paying off those type of debts. Because look, I know Bo said you're the cautionary tale, but it's one of those things where I think you and your spouse can definitely get this accomplished and overcome, because you're hanging out and watching a financial show called The Money Guy Show. So that is a really great start. You don't have to be perfect to still come out on the other end with tremendous success. So I would encourage you, just stay the course, follow and be inspired, and let the system actually nurture and accelerate your path. That's what the financial order operations will do.
Can I ask you to expand on just one thing that we've seen play out practically? Because he said, hey, should we shut down all our savings and pay off this debt? And you've had people that have done this before. Like, you have people in your life that have said, hey, I've got to get out of debt. I've got to be debt free. I've got to be debt free. I've got to be debt free. I think there was an attorney who I'm thinking of. Just talk a little bit about that and why that was so bad. She was
very successful, very good attorney, did have student loan debt right out of school, and I found out that she was not. She worked at a good law firm that had a really good retirement plan, found out that she was doing zero money to the 401k, even though there was a great match from this employer.
Because she was so excited.
She felt like she had to get out of all debt. And I was like, you'll never get those years back that you're at that age. You'll never get the years back to get that free money from your employer that's the equivalent of 100% guaranteed rate of return. That's why I really do talk about the financial order of operations, is because we try to really do the assessment. We go through triage for you of what do you need to do first. That's why highest deductible is number one. Getting that 50 to 100% guaranteed rate of return with your employer making those contributions, because the government incentivizes that. That's very important. And then step 3, now let's focus on those high interest debts. And look, high interest debt, because I know credit cards are even like at 20% right now. And you're like, how in the world do you have employer match before credit cards with 20% interest rates? I would say is because very few things are going to give you 50 to 100% guaranteed. So that's why we've tried to give you the path that lets you maximize, but also have a path to get out from under the weight and the pressure of this debt.